Welcome to Stock Market Investing with the ARMR Report. I'm Brett Rosenthal. Thanks for joining me on our week in review. We do it every Saturday at 11:30, so thanks for being here. It really gives me a chance to order my thinking and get myself ready for the trading session next week. And I hope in these conversations you do the same. So the ARMR Report stands for Algorithmic Risk Management Research. Okay, and what we do is we break down our process into a three-stage progression. We start by building our whiteboard. That's our fundamental research, and I'm going to share ideas with you today of stocks that we're adding to our portfolios. Then we use ARMR algorithms. The algorithms help us execute, tells us when to commit capital, when to take capital out of the market, risk on, risk off, those types of things. I shared with you the last couple of weeks that our index-only portfolio has 143% exposure to the market. Market went out at the highs this week, all-time highs. So we're going to go over why we're situated like that in our index-only portfolio and what we think will happen next week. And then what we're going to do, we tie all of this together. That last stage, the third stage of our process is stop loss discipline. So I'm going to go over with you a couple of positions where fundamentally we love them, but because of our disciplines, we avoided massive train wrecks. And I share this with you so that over time you can learn this ARMR investing way, this three-stage process. And if you keep executing it over and over again, putting yourself on the right side of probability when reward is worth risk, your P&L will take care of itself. Okay? So obviously, I'm going to share information about stocks I'm buying personally. It doesn't mean you should run out and buy them. I don't know you. So usual disclaimer, please do your own research, your own homework, figure out your own risk tolerance. But I will share with you a number of stocks that I'm buying personally. So let's start. Of course, if you want, you can subscribe right down here. Although I would tell you, subscribe to the YouTube channel, that's for sure. The ARMR subscriptions are going to change next week. Hopefully, I'll have them out by next week. So different pricing plans, a couple of different choices for you. You might want to hold off and wait till we launch that new subscription page. Of course, it'll always help if you give me a thumbs up. If you enjoy this conversation, thanks so much if you do. All right, so what we're going to start off doing, we're going to dive right in here. This is the ARMR Report. So when we click on for ARMR Insiders as a subscriber, takes you back to really these four main pages: our portfolios, our whiteboard, exclusive video, and risk monitor. The risk monitor tells us what we're looking at when it comes to, and I know a lot of you have been following me for a long time, so you already know this, bear with me. We have 8 indexes. We have algorithms written for those indexes telling us when to be risk on, risk off. When we get confluence across the board and all the indexes are telling us one thing, that's when we get very aggressive and the light will be green, okay? Once we get that after a 5-day window, we change that light to yellow, and that means we're managing success, we're changing positions, and I'll share with you some of the changes we made this week. Hang on. All right, there's my son. Who knows what he's up to? Okay, so I digress. Those 8 indexes are telling us to be risk on, and this is why we have a lot of exposure. So let's go take a peek at the portfolios themselves, or the indexes themselves. Now, what we did last week, we got stopped out of the ARC portfolio, the ARC part of our portfolio, all right? The innovators are the wrong place to be in this market. So let's see, this was Friday, Thursday, Wednesday. So right back here on the first breakdown, right in here, we exited this position in the ARC innovators. For those of you following us, ARMR Insiders know we exited that position before the real destruction this week. And so that gets us to part of the ARMR investing way. We are defending capital, okay? We start by using stop losses. No matter how much I like Pinterest, Snap, Twitter, Etsy, I don't care. Put the name down that you love. These are innovator stocks. Those stocks aren't working. The only way to save ourselves from ourselves is to use stop losses. So what we do here is we For instance, I don't know, some of you know I was a big fan of Fastly, for instance, right? Okay, we don't own a share of Fastly in our portfolio. We owned it right in here, and we got stopped out on a tight stop, right? Actually, right here, and we avoided the collapse in Fastly, right? We had shares of Etsy in the portfolio at one time, trying to break out of a pennant, right in here as it was breaking out. We had a tight stop. We were stopped out right there. Stock imploded. And the list goes on. And I only share that with you because we're only as good as our whiteboard. All of us, we're only as good as our whiteboard. Okay, so if your whiteboard's overloaded innovator stocks, you're having a very difficult year right now. My year started that way, right? An overloaded whiteboard full of my favorite innovator stocks. And over the last couple of months, the ARMR portfolios have been shifting. We've avoided collapses in our favorite names. And instead, we've rotated into names like Cliffs, for instance, okay? We're finding chart patterns that look like this, okay? And you're getting major moves off of the lows. And of course, Cliffs is a steel company. How about Waste Management? We talked about Waste Management right here on this very show, a Saturday right here in this blue flag window. We talked about it. We own it in the ARMR portfolios. The stock has only gone straight up, and it seems to be riding the third standard deviation above the 200-day moving average line. So, step one for today, how are we going to trade next week? We are all systems go in ARMR portfolios. Index only is 143% long the market. How do we do that? We use QLD and SSO in that portfolio. Those are ETFs that are twice the performance of the S&P and twice the performance of the NASDAQ 100. They give us growth stock type returns without the risk of an individual name. So it's a pretty good idea for a swing portfolio, and for an index only portfolio, that's what we use. Then we've swapped out of the ARK fund. Look at what we did, okay? The ARMR index only portfolio, we had a stop that was hit right here on this down day in the innovator fund. So we avoided the collapse. And what we did was subsequently to that stop out, we got a new risk on entry point in the value index. And so we got long the value index right here. And the last 2 days of the week, the value index is ripping to new highs. Okay, so you've got to read and react to the market you're in. You can't be dogmatic and say, these are the only names I like. There will be time again for the innovator stocks. They're still on my whiteboard. I love the innovator stocks. I can't wait to buy them again. I'm not looking to buy them right now. These stocks have been destroyed, and it takes time for those patterns to develop for us to start buying them again. I don't care if they have a rip off the low. It doesn't matter to me. What we need is a consolidated effort. So I like to say, and I've been saying to ARMR insiders this week, maybe even I told you guys this last week, I can't remember, but 2020 was the year of overweighting the portfolio. We had 50, 60% exposure to precious metals at the bottom of the market in March last year. It really worked, right? We had 60 plus weighting of innovator stocks later in the year, and that really worked, right? We had major alpha. This is the year for balance. We're getting massive rotation inside of a mechanical bull market. What happened this week was more mechanical fodder that was fed to the stampeding mechanical bulls, right? And that was a bad employment number. Don't forget, when you're in a mechanical market, bad news is good news for the market. Good news is bad news for the market, right? If you're in a market that goes up because of Fed intervention, Fed largesse, then you need bad economic news to make participants think the spigot's going to keep running, the market's going higher. On May 4th, Tuesday, my birthday, market plummeted because of an erroneous story about Janet Yellen saying that she thinks rates have to go up, okay? At 1 o'clock in the Slack room, we run a live Slack trading desk. So all day I'm sharing information with insiders, and they're sharing information with each other and with me. And I came on at 1 o'clock, And I said, this trade that's going on in the market right now, this collapse on Tuesday, first of all, it was within an expected volatility range. So the market hadn't broken down yet. There was no reason to panic. It was ugly if you stare at your P&L, but you don't make money staring at your P&L. I like to say that you don't watch your P&L, you watch your positions. You don't manage your P&L. You manage your positions, and your P&L follows. Okay? So in the midst of that collapse, I came on at 1 o'clock. I said, number one, the market's within an expected range. So it really hasn't done anything. It's just gone from the top of the range to the bottom of an expected range. Number two, this is a classic algo trading trigger. You know, there are algorithms written that crawl news wires looking for word clouds. And when they get Yellen, interest rates, inflation, they start hitting the sell trigger. It's an algo. It doesn't stop to think at all about what was said or who said it. This is a truth. This is a fact. There's a lot of money run off of algos like this. They're neural networks that they think they can, they can read information faster than a human and put the trade on correctly. It's ridiculous. What do they say about what goes in comes out the other side? You know what I'm saying? So if you're shoving the wrong information into the algo, it's still going to get the bad trade. And that's exactly what it did. Unless it's a day trading algo. And so it made a lot of money and screwed a bunch of people that day. But I came on at 1 o'clock and I said, everybody, look, relax. I asked everybody on that in the Slack room, how long do you think it's going to take for somebody in the administration to walk back what Janet Yellen just said? And then I think at around 4:30 or 5 o'clock in the afternoon, that was exactly what was happening. Somebody in the administration said Yellen didn't mean that, blah, blah, blah. Then she came out and walked back the comments saying that's not really what I said. And all of that volatility, all it did was show us where we have to focus our investment efforts. Okay. And so we had some huge day trading opportunities this week on our trading desk. And so the new ARMR subscriptions, there's going to be 3 subscriptions that we're offering to all of you who want to become subscribers. One, what we're going to offer is a simple ARMR Original. Okay. An ARMR Original. And this is the way I created the ARMR Report, which is for individuals who can't watch all day, who can't be part of a Slack room, who've got jobs. They can't, watch the live trading desk all day because of their jobs. And so what you need is the information at the end of the day or before the trade in the next day. And so there's going to be one offer for just ARMR Originals. Okay. And then what we're going to have is ARMR Extra Crispy, where you're going to get all of those opportunities of getting into our website, seeing our portfolios, seeing our risk monitor, seeing our whiteboard, getting exclusive videos. That'll all come with ARMR Original. But with Extra Crispy, you're going to get part of the Slack room. You're going to have that contact with all the other ARMR insiders, and you're going to hear what's happening through the Slack room all day. And then, of course, ARMR Pro will be all of those things, the Slack room included, and live trading desk. So you can see my screen and you can watch me trade. And I share with you, which we were doing this week, unbelievable trades on the short side in the S&P and the NASDAQ. We were buying puts in the market, making a killing on days where the market was, imploding and then reversing and trading higher. So I did a video for you guys, an education video of how we traded the S&P on this day right here. This is a day trading screen. Okay. And we were short in here, booked a profit, got long, huge rip higher, shorted the double top. So we're just trading between all of these lines. And I'm not going to go over this all today. We don't have enough time. But suffice it to say, on our trading desk, I share that screen and I walk you through the trades I'm doing. So how are we going to trade next week? The ARMR index only portfolios maxed out, and we're going to keep riding this train. The swing portfolio, the invest portfolio, this is the year of balance. And so what I submit to you is that we have built a portfolio. And you might want to write this down. In my opinion, this is the way a portfolio should be structured. You can decide what you want. But what we want in our portfolio is we want big cap tech. You see, when technology is getting destroyed everywhere else, when innovator names are getting destroyed, there's a massive amount of capital out there that only invests in technology. It doesn't leave technology. It rotates around the technology universe. And when innovator type stocks are getting destroyed, money hides in the biggest and the best names. And right now, that's a good place to hide because the earnings are explosive in these companies. So in the ARMR portfolios, I'm talking about things like, you all know we own Microsoft right in here, right? Right in here off of these breakout pullback. Okay, Microsoft's an example of what we're talking about. Maybe you're familiar with the fact that we picked up shares of Apple. Okay, this is a cup and handle in Apple. The stock hasn't even taken off yet, but this market's not going to rip to new highs without Apple going above 140, in my opinion. Okay, this is just simple. Here's an addition from last week. Okay, Cisco Systems. Classic major breakout of a huge base. These are low risk, high reward entry points in a market that's rotating, looking for safety and growth at the same time. Take a look at IBM, same chart pattern. Excuse me. The stock paid its dividend, which is something like 5%, depending on where you bought it. Okay, down here, right? So the stock blew out on earnings and just paid its dividend yesterday. So it's actually not, that wasn't really part of that decline is paying the dividend. It went ex-dividend. Okay. These are the chart patterns that are working. Take a look at Teledyne. Holy smokes. Look at these chart patterns. Massive pennant breakouts of old school big cap tech. So that's one place we've got to be with capital. Okay. Another place we want to be are the industrials. I'm not going to go over all that, but we know what we're talking about. The steel and, I'll give you an example of one stock we added last week. DuPont. Look at the chart patterns. They're all the same. Blowout, pullback, consolidation. The color scheme you see are the different type of entries that the ARMR report looks for. The green entry is what we call an ARMR value entry point, and it's based on reward to risk ratios. The second entry point is an ARMR hybrid. Still a lot of reward, risk a little higher because you're well off the lows, right? But of course, the stop is going to be right in here. So we use tight stops. So we're adding some shares of DuPont. These are the type of, look at that's a lot of catching up to do. All right. How about the energy stocks? Right? Another stock in our portfolio. You can see they're all the same type of patterns. These massive pennant breakouts of a long-term downtrend. And either you buy it before it breaks the pennant down in here, or you buy the first consolidation after the pennant breakout takes place, which is what we did here in Chevron. Okay? Then what we want to have exposure to, so we have big cap tech, we have industrials. I think it's really a dereliction of duty that I have avoided financials. It's a big mistake. And so what we've done on Friday is we added shares of JP Morgan to the portfolio, and I'm looking for other names. And again, you could do the same pattern on JP Morgan, and this is a much higher entry point. So it makes me a little bit more, disturbed. But at the same time, that is the same type of pattern that's making us a lot of money this year. And buying the first consolidation at the 50-day moving average. Okay, so there's your pennant breakout. So I should have been on it right here, and I wasn't. That's kind of embarrassing. This is the first touch of the 50-day moving average since the breakout. And if you look at a bigger picture, actually, let's go to the weekly. What I was going to do is really go up to here. This was the original breakout here to a new high, and it's just consolidated that move. And so we're adding to it here. I could also own shares of Goldman Sachs. And I'm going to explain why in a minute. I don't own them right now. I really should. Okay, Goldman's just running away. And I think that perhaps Jefferies is an interesting stock to take a peek at next week. We don't own Jefferies right now, but I might want to do something there. There are many financial names, but we're going to highlight JP Morgan and Goldman Sachs in a minute. It's going to apply to the last piece of this puzzle I want to share with you before I get to your questions. So what we're focusing on, big cap tech, balanced nicely with industrials, okay? Adding some financials. Now, my pet project is always cannabis. Okay. And so we bought some cannabis, as you all know, a couple weeks ago, MSOS. I'm not going to go over all the names right now, but that was the bottom at 40 we were looking for. We added MSOS. It took off. It pulled back. It's going to make a consolidation. I'd like to build that position size. I might do it by owning shares of YOLO. I like this double bottom that's forming. Okay. I don't want to own shares of MJ. I just can't get my arms around it because there's too many things inside of MJ I have no interest in. Okay. So I'm not going to own MJ. If anything, I'm going to use MJ as a hedge. If I get long these other names and I need to short something for a particular day to protect myself, I'm going to be shorting using MJ. Okay. Here are the cannabis stocks that I think we have to really pay attention to if we want to buy individual names. Organigram, Village Farms, and Telray. If we have an interest, and this is now the combined company of Telray and Afria. Okay. So I'm trying to speed up this conversation, but to get to your questions, but bottom line on cannabis, we want to focus on U.S. cannabis. I'm going to use MSOS and YOLO to do that. Will I own individual U.S. MSOs? Absolutely. True Leaf, Green Thumb, all my favorite names. But I really like focusing on the ETF. It's easier to get in and get out for me. I'm managing a lot of capital, and it makes it easy for me to make a decision and manage that position. So I make MSOS or YOLO bigger position sizes so I get the same type of upside, and I have the liquidity and the comfort level. That's what I do personally. You should do whatever makes you comfortable. The way I view the ARMR Report and these weekly conversations with you is I hope you view it as a guide. It's not a, you have to do X. I don't know you. I can't possibly tell you that. Your risk tolerance is different than mine. Your portfolio size is different than mine. Okay. So what I hope that you get from this is if I'm saying to you, in May of 2019, I've sold every single share of cannabis. I own 0. I hope it makes you think I better protect my assets, right? And then they dropped like, 50 to 90% from that level. And then last year in June and July, I say, I'm starting to buy cannabis stocks again. And it lets you know, okay, the window's open to start taking some risk. It's a risk on, risk off suggestion based on ARMR algorithms, getting us on the right side of probability over and over again when reward's worth risk. Sometimes we're going to get stopped out. Other times we hop it on right and we have a massive ride. Okay, so window is open to put money in cannabis. Do it however you wish. I'm choosing to use MSOS and YOLO. And then some of my favorite Canadian names I think I might do that have access to the US market. But a couple of thoughts I want to throw out there fundamental thoughts that bother me. 2 things. It's just a minor annoyance, but why is Credit Suisse stopping their customers from buying U.S. cannabis stocks now? Like we're still dealing with this stuff. We found that out last week. If you don't follow me on Twitter, consider the follow. It's at Brett Rosenthal. I update throughout the week, and I retweeted this tweet about Credit Suisse. I think it was a Bloomberg story. Why now? I just don't get it. We have a government that is looking to change all the rules. We're all excited. And so somehow Credit Suisse thinks it's a good time to stop their customers from buying U.S. cannabis companies. I can't believe we're still dealing with that. And it just gives me pause. We're all cannabis lovers, I assume, from an investing standpoint, maybe from a use standpoint. And we think that it must be right around the corner where everyone else is going to see what we see because it's so obvious. And it really isn't. It really isn't that obvious. And it's going to take more time. So we don't want to get over our skis in cannabis just because we love it. We have to let price action tell us what to do. The action's getting a little better. I'll dip my toe a little bit more. I got a starter position. Okay. But I like to earn the right to take the risk. And I'm going to show you what that means in a minute when we talk about precious metals. Okay. But for right now, I've got my MSOS position. How am I going to trade next week? I might be adding shares of YOLO. I might double my MSOS position. I don't know. I might add some organograms, some Village Farms, but I need to earn that right to take the risk. I need to see price action confirm that a bottom is in. And there are still fundamental stories that I find perplexing. I'll give you another perplexing story. Those of you who think that Florida is about to go rec, I think that's a pipe dream. I'm beginning to think Florida is never going to go recreational. Now, that might not stop True Leaf and Parallel and Green Thumb from making a lot of money. I'm not saying it's bad for those MSOs. I think actually probably good for them. I feel like what's going on in Florida is that the medical market is such a juggernaut for politicians and for the companies that are in control. Why would they want to open it up? Like, I don't even see why they would want to open it. There's an entire business setup of doctors. In order for you to get access to cannabis in Florida, you have to pay a doctor to give you a prescription. I've done it because I'm an investor, so I'm curious, and I don't see anything wrong with cannabis use. So I've done it. I wanted to see what the process was. But there's so many middlemen here in Florida, and they're all making money, and all the tax revenue goes to Florida. Like, I can't see them making some big decision to go recreational. I just don't see it. And let me tell you something else. My favorite store down here is Certera Wellness, which is owned by Parallel, which is the stock CERAF is the company. It's a SPAC that's taken them public. 2-3 months ago, the packaging on all the products, I should have brought it down and showed it to you. Maybe I'll show it to you on some other video. It was like a, cool packaging that you would see on any other product. It was normal consumer packaged good packaging that was designed to catch your attention. Now the packaging is, there is nothing that can be done with the packaging that would convey to you what the product is. It's just a white vial or a white pouch that I'm honestly with a zip it zips shut. It's a white pouch. It almost looks like there's like a medical syringe in it. That's what it looks like. It looks like something you would see in a medical hospital. Or have you ever gone to the dentist and they open up a new set of like picks or whatever for your teeth, right? And it's in some type of sanitary looking pouch. That's what the product is sold in now in Florida. The Department of Health in Florida determined that every product has to look like it's something you would get on a hospital gurney. And this state's about to go rec, forget it. So I'm just saying, it doesn't make them bad investments. Actually, I think the longer the process takes, the better it is for the established players. So this is actually good news, I think, for True Leaf and Cresco and Green Thumb. So I'm not saying it's a bad thing, but I'm just saying you better reorganize your thoughts if you're in the camp that thinks all of this stuff is going to happen immediately because Chuck Schumer keeps blowing smoke, pun intended, about all the things he's going to do for cannabis. All right, I'll believe it when I see it. Okay? Sometimes I wake up in a cold sweat and my wife says, honey, what's the nightmare? And I say, oh my God, I had this nightmare that I was investing and, the success or failure of my investment depended on Chuck Schumer. And I was in cold sweats. I mean, somebody shoot me if that's the decision. So, don't believe anything comes out of that man's mouth. So we have to invest based on price action, quality companies, and use stop losses so we don't get over our skis, assuming that the world is about to accept cannabis. That's all I have to say about cannabis. Let's move on to the number one story of today, and that is precious metals. So what do we have in our portfolio? We own big cap tech. We own industrials. We own some financials now. We have a little bit of medical in there. Okay, big cap pharma. We're always going to have cannabis because I love cannabis, but I'm going to manage that risk. I think we just beat that horse dead. Okay. But one of our biggest exposures right now is precious metals. Okay. Now, we've been working on this for a couple months, so you should not be surprised. And I hope if it fits your risk profile, blah, 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 okay, that you've already positioned the asset and you're making money, okay? The way to make money in this market is to pick up assets before everybody else is screaming about them. That's true in most markets. Last year, you could get away with hopping on the bandwagon of momentum because it was an insane year. Okay, this year you have to think ahead and position yourself early, and then when you earn the right to take more risk, you add to it. So let's go look at what we're doing in the ARMR portfolios. Okay, let's take Newmont as an example because this is our favorite big cap gold stock. All right, that green box there was the ARMR value entry point. Early March, I shared with you all, we are out there buying Newmont. What's the risk? What's the risk down here? The risk is it takes out these lows and the whole thing is over and it's going to implode. Okay, so there's not a lot of risk there, but the reward's enormous if this is about to be the beginning of the next leg up. And there was unbelievable synergy as, you know, the previous March is when we bought these assets and had a huge rip higher. Okay. So we started building our position here. And I shared with you the top 4 names in our portfolio: Newmont, Wheaton Precious Metals. The green square is where we've been buying the asset. Okay. Franco-Nevada, right here off that reversal. All it's done is gone straight up. And can I just take a minute to share this thought with you? You've heard me say this before, but Franco-Nevada is a great example. Your best investments never challenge your stop. This is why I like to use the low of the day I bought it as my stop, or the low of the day before, because sometimes you have a big up bar and you buy the next morning. So either the day I bought or the day before. That's the best stop. Look at what happens in stocks that work. Okay, so this thing blew out. I think we were in here buying it somewhere in here. Never challenged the stop. Not even close. Just skyrocketed. Okay, those are the entries you want. And if something's challenging your stop, there's usually something wrong. So cut your loss, reassess, put the position back on if you have to. And then here's Royal Gold. Beautiful, beautiful triple bottom right here at the downtrend. We were buying it right in here, right? What's the risk? Okay, so it takes out these lows. Very tight stop. Instead, we're in cheap. Now it's starting to run. Now everyone else is talking about precious metals and the stocks are running and we own them cheap. Okay? And the last piece to the puzzle here are the silver stocks. We started adding the silver stocks a little bit right in here. Okay, and we've waited to add more. Okay, and what we did was we actually added some, believe it or not, on this day. See that big tail down? That's actually not a real print. I don't know what that was. It traded somewhere right around in here. 15. Did it get down to 15? No, it got down to 15. We paid $15.30 for it on this day right here. And the next day it reversed and skyrocketed. Okay. So we have our full allocation on anywhere between 25 to 30% of our portfolios long precious metals. And now I'm going to give you a couple fundamental reasons why. Don't forget, if this is wrong and price reverses, stops will be hit and we'll go back to cash. But I think we're on the precipice of a massive revaluation in the price of gold and silver. I told you this a couple months ago when we started buying the stocks. Let's refresh our memory. Basel III goes into effect June 28th. This allows for 100% release of the value of gold bullion on the balance sheets of central banks and other banks, any bank, okay, as a reserve currency. Right now, there's a 50% haircut. So if you're holding gold bullion, you only get a 50% a credit on the balance sheet. That goes to 100% on June 28th. Okay, here's a couple things you need to know. Through various sources, you can find them yourselves. They're all over the internet, whatnot. Central banks are aggressively dumping US dollar assets and building up their gold assets. You don't believe me? Maybe you do, but for those of you who don't believe me, take a look at what's going on in the US dollar. Now, we talked about this. This is UUP. the US dollar ETF. This is a head and shoulders right here. And I revealed this to you. You guys, we all talked about this last year, last July. This was the breakdown. It's just getting worse. And it started again in earnest in April. Don't forget, this is interesting. See, we were buying gold stocks right in here. Gold stocks were going up while the dollar went up. That was in March. Gold stocks were going up while the dollar went up. Now the dollar is accelerating lower and gold stocks are breaking out. Okay? Something is happening here. And what's happening is that June 28th, a major change is coming to how gold is perceived on balance sheets. I'm going to give you a statistic now that's going to blow your head off. The ratio of foreign debts outstanding to gold sits right now at between 5 to 6%. Foreign debts outstanding to gold price sitting at 5 to 6%. Historically, it averages between 20 and 40%. When we get past Basel III, it's our expectation based on historical norms that you could get a revalue, and I'm just using GLD as an example. I don't own GLD. It's just an example, the ETF of gold. But we're expecting a major revaluation. That revaluation based on those basic, even if we just revert to the mean, and I am a big believer in mean reversion of all types of assets, the ratio of foreign debts to gold is at an unbelievably suppressed level. If it just goes back to the bottom, the 20 to 40% average over history, historical average, you're talking $6,000 gold. What are we sitting at 1,800 right now? And that's the lower end of the historical. You know what happens when pendulums swing. They don't just swing and get to the lower end. They swing all the way to the upper end. I don't know, $10,000, $15,000 an ounce? I don't know. You think I'm crazy? Maybe I am crazy. Dream big, you know? Dream big. If price argues with what I'm saying, we'll be stopped out of positions. But I'm sharing this information with you just to give you, in case you don't realize, the dramatic undervaluation of gold here. And this brings us to JP Morgan and Goldman Sachs. People think that they love to short gold and silver because they've manipulated it for so many years. But do you know on their balance sheets, they've been building up a huge gold and silver bullion position. They're long in a major way. They're long in a major way, and they've been developing that position for the last couple of years. We're in an environment where the players that have always been against us, if we invest in gold and silver, are now on our side and want to see a revaluation. And in this world of ridiculous bubbles, what can these metals go to? I'll let you decide. I'll let you decide. Okay? It's up to you to figure out what you think it goes to. Does this make me get 100% long metals? No. This is a year of balance for me. 25, 30% precious metals. I'm going to own the mining stocks because mining stocks generally have leverage in a market like this. And so when you get an explosion in price, the mining stocks should go up exponentially. Okay? I'm sharing with you the big cap names that I like. There's many small cap names you can go with. Okay? My point of the ARMR Report is it's a guide, and the window's open to have exposure to this space. The reward to risk is right. The probabilities are in our favor. And then we'll wrap it all up with a bow of stop losses. So if I'm wrong fundamentally, we don't get destroyed. Those are my thoughts for this weekend. I hope it helps. Let's get to your Q&A. All right. And of course, guys, don't forget, If you want to subscribe to this YouTube channel, you can do it right down here. And certainly if you like this, if you've enjoyed this conversation, hit that like button for me. I'd appreciate it. It helps me out. All right. So what do we got here? Quail Hollow. Good morning. How are you, Stephen? We did. We had a great week of alpha in the ARMR Report. It's true. Thank you for that. Thanks for those comments, Stephen. It wasn't easy, right? I mean, there's been a couple months in there where I've been trying to figure out what is the right exposure. And it's hard even for me. You teach best what you most need to learn. I mean, I struggle with the same things you guys struggle with. What makes us different, perhaps, is that I have a unbelievably firm understanding and execution of my stop losses, so I don't bury myself in a fundamental idea that I like. That's like the single biggest difference between a successful money manager and someone who's struggling. It's if you could just master that, your performance will go up. You can get over your ego, and say, okay, what I'm building is not right. Where else can I go? What am I missing? And start shifting your portfolio when stops get hit. That's what you do. Hey, Ms. Tuitt, thanks so much. You like the website? Excellent. All right. What do would you like to take a look at? DY and STX. ICOM. All right. I mean, unless I have a fundamental opinion, I'm just going to look at stock chart patterns for us, and I'm going to model it out. Right in here is your original green value entry point. Then every time it comes down and touches the 50 and makes a consolidation, it's a higher and higher entry point. So the further out you get from that value entry point, the more aggressive your entry. And this becomes like what I would call if it was color coded, an ARMR momentum entry. And I'm just not buying momentum entries right now. So I'm looking for other entries. And same with, obviously there's nothing I can do here in Seagate. It looks unbelievable, Jason. If you own it, well done. You're killing it. Would I sell it? No. I mean, I usually book some profits when I get close to this top light blue line right here, which is 3 standard deviations above the 200-day moving average, which is down here. So when I get that far away, I usually book some profits. Like, if you look at waste management, okay? So we've been riding up this 3rd standard deviation for a while now. And I wouldn't necessarily sell any waste management here, but on this leg up, makes total sense to book some profit, maybe 25%, and then ride the rest. Hey, thanks so much. Thanks so much. Had a good birthday. Greg, I can't do, I have an insider who sent me an Audible book, the Bitcoin Standard, and I'm listening to it right now, and it is fascinating. And it's not that I won't be in cryptocurrency at some point. I'm doing research on the companies that facilitate crypto. I'm an equity guy. I don't need to play everything. I think you have to play to your strengths and do what you're good at. So to me, for instance, my favorite company in the space is probably this. I think at some point, Silvergate is a no-brainer of an idea to own in a portfolio because it's the bank that facilitates crypto business. It's a commercial bank. It's a fascinating story. I was on the conference call again this week just to go over it with myself and try to understand more what they do. So I'm glad whoever's making a lot of money on crypto is making the money. I feel like there's a ridiculous bubble going on. So until you actually book your profits, I wouldn't break out party hats because the way crypto trades, and then what was it? Ether, classic was $170, 1 minute, and like 10 hours later, it was $118. So, until you've actually booked a profit and show me the cash that you have, I don't know, you have some asset that's skyrocketed. If you ride the whole thing back down and have no stop discipline, no trailed stop discipline, you're not thinking of how to book those profits. I don't know where we're going to end up. So anyway, moving on. This is what I'm saying. JP Morgan, I think, is a play on gold, and so is Goldman Sachs. But I'm not buying it for that. I'm buying it because I think financials are going higher and this stock should be bought. And it's the first entry point after the original breakout. So I'm going to put some money to work. But I wouldn't be surprised if they have some big earnings numbers when gold blows out because they're so long gold. All right, let's take a look at these stocks. What did you just say? DYAI. Develops enzymes and proteins. I don't know anything about this company. I got nothing for you on that. What else are we looking at? AFCG. I don't know either of these companies. AFCG. I just try to share information that I actually have something worth saying. Okay, a REIT that organizes secured loans and other loans for legalized cannabis industry operators. Huh? What's this? AFCG? A REIT that originates secured loans and other loans. So, for medical use. So, is this like IIPR? Targets acquisitions, industrial real estate? No. I'm going to have to do some work on this. Originates secured loans and other loans for legalized cannabis industry operators for medical use. Well, that's a fascinating idea, and I'm going to get all over that, and I appreciate you sharing with us today. I'm going to write this down. I'm going to write this down right now because I got to get on that one. AFCG. I'll be all over that conference call. Come back next Saturday, ask me the same question, and I'll let you know what I think. Ah, geez. I have a history with this stock. Oh, no, Harvest. Yeah. Oh, no, Harvest is great. I was thinking of something else. Yeah, I mean, Harvest looks phenomenal, right? I think that company actually gets taken over is to it. So it's always been one of my one of my favorite names there, and it really looks phenomenal. I think it's going to be acquired, but that's just rank speculation. Don't buy it for that. Ascend, they have New York exposure. All right, I'll take a look. What's the LOL for? I don't know. Oh, oh yeah. I mean, it's a nightmare I have. I'm investing because I hope Chuck Schumer does the right thing. Oh my God. Would this be long-term for gold with this new rule on 20? It's definitely long-term. This has been in the works for probably 5 years now. I mean, this is, when you have massive debts on the balance sheet of corporations, but really I'm talking about countries now, right? Huge debts. We're spending massive amounts of money trying to get out of this economic hole because of the Wuhan virus. Okay. And so one way to balance the books of a country, right? Because don't forget, gold is an asset at Fort Knox for the United States of America, right? So we have these huge liabilities and we have this asset here. Well, if you revalue the asset 3, 4, 5 times, all of a sudden your books look pretty good, which protects the US dollar, right? So it's actually going to protect the US dollar if gold goes up a lot and balances the books. I mean, this is a long-term story that's been unfolding at a snail's pace for probably a decade, okay? And what I think may happen at some point in here is it goes from a snail's pace to a rocket ship. That's what I think may happen. And so we'll see. We'll see. All right. What else we got here? Yeah. Yeah. Disney. That's a great, I'm gonna reveal to you that I had a trade on Disney last week, right here on this move, this bar right here, and I got taken out the next day as it broke back down below my stop because I used the low of the bar I bought or the low of the previous bar as my stop, and I got stopped out of it. Now, it doesn't stop me from putting it back on. I'll put the position right back on if I think I have to. But here's the problem as I see it, Alina. This is a market that's been brutal if the earnings number does not come in the way the street wants. And this is a market that's not really paying you for great earnings announcements. So why do I want to take the risk and step up early into Disney? I just don't know. Like, I don't get it. Like, what's the upside for me? Let me give you an example. We had blowout earnings numbers on Amazon. What did the stock do? Stock came right down. Now, I mean, I'm actually buying Amazon right here with the low of this of Thursday as my stop, because I think that chart pattern is going to break out, and I think it's going to follow shares, of Google and Facebook. We bought Facebook right in here, and the stock is just, taken off. But even Facebook had blowout numbers. Stock was up 7-8% that day, and it came right back down. So even if I didn't own Facebook on the gap up, if I was patient, I could have bought it right down on the gap closure. So why do I need to take the risk in front of an earnings number? Meanwhile, you miss the number in this market like Netflix did, and the stock craters. So I don't see the reason to take the risk in Disney, and I'm not going to hold it into earnings. That's just me. The risk reward's not right for me. Nokia. Oh, that chart looks great, doesn't it? Boy, I'm glad you brought that up. I'm gonna have to put that on my list. At the very least, that's a stock to day trade. Darn, that chart looks good. Are they finally turning a corner there in Nokia? If they are, it's just started. I have to listen to a conference call. It hasn't even started yet. We haven't missed anything in Nokia if this is the beginning. So this is a good time to ask that question, and I'm going to do some research on it. Ask me next week, Dennis, after I did a little bit of work on it. Maxim. I don't own any of the semiconductor stocks right now, but Maxim is on the list as a name. The chart pattern looks great. You could certainly buy it up here. I just don't own. Here's how I'm building my portfolio, Daniel. I have an allocation to big cap tech. I only want X percentage of big cap tech, and I consider semiconductors to be part of that big cap tech world. So I already have my allocation. And so if I'm going to add a semi stock, I have to take out something else in my portfolio that I'm not willing to take out yet. If something gets stopped out of my portfolio and I want to maintain my exposure to big cap tech and I want to add some semi, I might. And I think that the semi that I would add would be NVIDIA. But I do like the Maxim chart pattern. Okay, but that NVIDIA chart looks perfect to me. Blowout, pullback, test. If it holds here, the low of the 50-day moving average, that Thursday low would be the stop. That's so compelling to me. Yeah, uranium stocks look great. You're just running away. Great call. Great earnings announcement, I guess. Right, that was a pretty good earnings announcement. And then you got DNN. The only two stocks that I'm willing to own are CCJ and DNN, because these are real companies that actually have real earnings and revenue. The other ones, they're not, to me, not, the risk reward's not right. Excuse me, but CCJ is the best company. And it's, leading the way. What a sick move that was, huh? Then the government just came out over the weekend and said they're going to suggests subsidies for nuclear energy. So great. Now the government's going to get involved in subsidizing the business. What do I think of casino stocks? I can see the allure. I can see the interest, and I certainly think that's the right chart pattern. So these are the patterns that are working for me, right? Just drawing the pattern for you. This is what's working. I don't own them, but there's nothing wrong with them. And then this is your first pullback to the 50-day. So here's the breakout, original breakout right here. This is the pullback to the 50. You would set up a low. Your stop would be right in here on these lows. If it takes out those lows, then we're wrong on casino stocks and we don't want it. If it holds those lows, you've got a good position on probably. No, it's not based on gold anymore. It's based on the full faith and credit of the United States government. And so what I'm saying is, if the U.S. government has massive amounts of debt and the U.S. dollar is going down because there's concern out there that we can't service that debt, and then we have on our balance sheet gold, and gold prices skyrocket, all of a sudden it makes our balance sheet in the United States of America a more sound balance sheet, which means the currency of our country is more sound. We're just spitballing. This is 30,000 feet discussion we're having. Yeah, I mean, Penn has come all the way down to the 200-day moving average. And of course, you can't talk about Penn without talking about DraftKings. So to all of you who are convinced that I missed DraftKings, do you still feel that way? I missed a trade in DraftKings, that's for sure. I'll give you that. There was an opportunity to swing trade DraftKings and I didn't do it. But I haven't missed these stocks at all when it comes to long-term investments. And here's why. So it's on my radar. Penn and DraftKings are on the radar. Let's see if I can get them the next time off of the bottoms. But these are stocks that are examples of innovator stocks. I really look at my portfolio and I look at positions and I try to see. You can do this on your own. You can go to ETF.com. You can put Penn into that website, search, and it'll show you all the ETFs that own the stock and which ones are the biggest ones that own the stock. And so what you're going to find is, in many cases, some of your favorite stocks that you think are on their own are really core holdings of a bunch of, let's say in this case, innovator ETFs that are getting destroyed. And so when the ETF drops, everything in there is sold. It doesn't matter how great Penn is. Money is flying out of the ARK Innovator funds. And so Kathy's got to sell everything in the fund in order to keep the percentages correct. And so it can destroy a position in a short term, which creates great buying opportunity for the investor. So we put them on our whiteboard, we watch them, we wait for them to form a base. But that's going to take time. You see, there's a bunch of people trapped in Penn at 140 now, right? And the stock is trading at 82 or whatever, 83, 84, 86, okay? So these people are trapped. It's called overhead, and it's going to take time to build a pattern. Okay, we're looking for patterns that are about to break out of long bases where the overhead is no longer such a dominant force. Okay, IBB and BIB is twice the performance of IBB. So I had a position on IBB up here. BIB is the same thing, okay? And when it went back, when it went down below, in fact, I think we exited that position right here on the 30th, okay? We stepped out of IBB on the 30th and then it imploded. If it holds the 200-day moving average, I have an interest, but it's very hard for me to invest in biotech when the government of the United States floats the idea that there should not be patent protection for Pfizer and Moderna. That is a sickening, disgusting thing that makes it very difficult to invest in biotech companies. If the United States government which has always been the forefront of protecting intellectual property, is now deciding that you don't have to protect intellectual property, it makes it very difficult to invest in biotech companies, which are all about intellectual property. I mean, most of those biotech names don't make any money. They're trying to discover drugs. And the only way that that investment makes sense is if you live in a country or an environment or whatever that respects the intellectual property that the investors paid for to create a cure for people. I mean, don't get me off on this tangent. This drives me insane. This just drives me insane. People are like, oh, it's such a nasty, bad thing that drug companies make money at the expense of poor people who are sick. Give me a break, man. Give me a break. How do you think you discover drugs? It costs money. I mean, it costs money. Hundreds of millions of dollars have to be invested to create cures, to save lots of people. Oh my God, you got me off on a tangent, brother. Holy smokes. People work hard, they should get paid for the work that they do. And if all of a sudden the government decides that intellectual property isn't important, it's very hard to invest in biotech stocks. Let's move on. X. X. And before I move on, does that mean I don't want to help people who don't have the capital to buy a drug to save themselves? No, absolutely. Let's address that issue. Okay? Let's address that issue. It's not a black or white thing. I'm a capitalist, right? I believe in capitalism. It's what built this country. It's what makes this country great. You want to tweak it a little bit? You want to help out someone who can't afford it? I get it. Let's do it. I'm not hard-hearted. Just because I'm a capitalist doesn't mean I'm hard-hearted. But you can't just disregard intellectual property. It weakens the system. And it's a system that's created a fantastic country. Anyway, steel, I love it. I wish I owned it. Every time it comes down to the 50-day moving average, I stare at it. I don't pull the trigger. Then when it starts to run away, I want to buy it. And I ask you this question, why are we like that as humans? Why are we like that as humans? It drives me nuts. When it's coming down and it should be bought, there's fear that stops me from pulling the trigger. And when the thing starts to run away, there's greed. I don't want to miss it, so I run out and pay up for it. I fight that constantly, okay? And so I did not execute when I should have, and I should have been buying X right down here. And there's no way I'm going to pay for it up here now. But the stock is phenomenal. The earnings were phenomenal. The new management team's great. The acquisitions they made last year are just important to the business. I love this story. And so I'm looking for my entry point into X, but I'm not going to pay up for it. And then Slang Worldwide, I really like that little company. I did research on it probably three years ago. But it's like a third or fourth tier company. It's like I got to make money in the big cap US MSOs first. If I start getting paid on those investments, then I can start filtering down into smaller names. My favorite smaller name right now is Kern. And I don't own it. Full disclosure, don't own it. Okay? But I mean, that's a company I really have an interest in. And I haven't done work on Slang in a while, so I have to go take a look. Oh, are you thinking of adding Kern? I didn't even realize you wrote that. Yeah, so Kern. I'm not adding it here though. I need strength to show up in the entire sector. I gotta start getting paid on my MSOS position, and then I might start filtering down. ID Doc, man, you could do whatever you want. You're just asking me my personal opinion of why I don't have more exposed to gold, because I think this is a year of balance, because I think it could be very frustrating for an investor. And I'm looking at you, Mo, right? If you overweight one sector and it goes down for a week and the rest of the market's going up, that can cause a lot of consternation. Okay. And so there are many sectors of the market I want to own. It's about creating alpha. It's about managing risk. And so even though I think this is one of the greatest investments of all time, and I think there could be this huge move up, how greedy do I have to be? I mean, I think the metal stocks can double from here. So my whole portfolio will be up 30%. That's not enough? What do I want to have, 60%? I mean, come on. I believe in the story, but I also believe in managing risk. This is the ARMR Report, Algorithmic Risk Management Research. And just because I believe in a story doesn't mean it's true. So I want to balance my portfolio and be able to deal with the volatility. And that's why I'm at 25 to 30%, depending on the portfolio. Saber, great. I mean, I'll just give you guys, the ARMR original subscription is something new that I'm creating. I'm not exactly sure what the price is, but somewhere around maybe $59 a month is what I'm thinking. And it's access to the website so you can see the portfolios, the spreadsheet, the breakdown of what's in there, what our stops are, what our targets are. You can see our whiteboard and our research that we're doing. You can see the risk monitor, and whenever it changes, you can get access to the exclusive videos. I do 2 videos a day for ARMR Insiders. As a extra crispy or a pro subscriber, you're going to see those videos live. But as an original subscriber, nothing wrong with that. You're going to see it at the end of the day. And then you can act the next day. So it's a really good subscription for guys who aren't trading, tick by tick with me. So anyway, you'll see that hopefully within a week, you'll see it. And I would look forward to having you as a subscriber. OHI, yeah, the energy stocks look really good. I've focused on the pipelines because of the fat dividends. So to me, the energy play, my favorite energy play, are these pipelines where I'm picking up ridiculous yield. And this, what am I doing here? Hold on a second. Let me see if I can get this. For some reason, I'm blanking on my, just sharing with here, ENB. All right, we own ENB, and here the stock's going straight up. So I'm having my proverbial cake and eating it, right? And how about Williams? We added Williams recently. Okay. These are chart patterns where I see low risk, a high reward, because I'm picking up a big dividend and the principal's going up. OIH is the ETF on the oil service companies, and it looks great. I mean, I think that's probably a great idea. The energy is going higher. These stocks look great. My energy allocation is somewhere around 15, probably 15% of my portfolio, maybe 20%. And I'm doing it in pipelines and then, CVX, but there's nothing wrong with OIH. That looks fantastic. All right, let's run through some chart patterns. ANET. Huh? Not a bad pattern, second stage base. Activision. I'm just going to look. I'm not going to comment on each one. If there's something that really intrigues me, I'll let you know. These patterns, this is like a third stage base. Not, just not the pattern I'm looking for. Don't know that business, but again, that looks like a momentum entry. I wouldn't reach for that. This is just me, personal. Advisor Corp. It's an interesting pattern. I mean, this was a massive, sell-off here. It looks like an innovator stock. I don't know. I got to do some research there. I don't know that company. and MTZ. I mean, it looks great. If you own it, I wouldn't sell it. But again, I'm not. These aren't patterns to be bought. So there's nothing in there that really intrigues me. All right, guys, listen, this has been lots of fun. As always, I appreciate your time on a Saturday. I look forward. Any other questions, shout them out before I wrap up here. COHN. Not a bad chart pattern. COHN. What is this? Asset management. But look at the volume. It trades on average something like 900 shares a day. How am I supposed 10,000 shares a day? There's no possible way I could own that. Jersey Devil. No, there's no way. Something trades that thin. I mean, anybody could sneeze and the stock could be down 50%. One institution. I mean, forget it. I need liquidity to buy a stock. So that's just me. But that's because I'm managing a larger pool of capital. I don't know what you're managing. So if I was managing a smaller pool of capital, I could buy something that has trades less shares a day because I can get out of it. That's something to think about. They're guys that do the SPACs. It might be a great investment. I can't get there myself. Okay. So anyway, if you want to subscribe, right down here, the website, obviously, I'll get new subscriptions up next week, hopefully. So take a peek at that. See you guys next Saturday. Don't forget to hit the like button. That'll help me out. Last comment of the day. Anything last minute? Stephen, you're already in the Slack room, brother. Unless Quail Hollow 2012 is somebody other than Stephen. Not exactly sure I understand that question. But anyway, you're already covered if that's Stephen. If not, the Slack room starts with what I call ARMR Extra Crispy and then ARMR Pro. Both of those include the Slack room. So the best way to understand it is the ARMR Original, which I'm going to come out with, is a less expensive version that just gives you access to the website so you can see things not real time, but at the end of the day when it suits you, let's say you're working all day, you come home, you want to get yourself ready for investing the next morning, you'll be able to access all that information, right? And then, if you're a real-time trader with me and you're involved all day, there's different subscriptions that suit the situation for you, okay? All right. So see you next weekend, guys. Have a great weekend. Oh, happy Mother's Day to all of you out there. Take care.